It is the feeling that keeps you focused, the distinct sense that the structure is set up in a specific way. Even if you can't see the mechanics, you work more hours than the previous generation, you are more productive, you have more technology. And yet, the house they bought on a single income is mathematically difficult for you on two. The grocery bill that used to be small is now a source of concern. You move faster, but the goal keeps moving further away. They call it inflation. They call it supply chains. But what if none of those are the main cause? What if the gap between the ultra-wealthy and everyone else isn't an accident, but a feature of the currency itself? It is not a secret plan. It is a law of economics. It has a name. It is called the Cantillon Effect. And once you see it, once you understand how currency actually enters a system, you will never look at a price tag or a stock chart the same way again. You will realize that while you are working for currency, the currency is changing value. In this documentary, we will trace this economic force. We will go back to 18th century Paris to meet the banker who defined it. We will look at the massive liquidity events of the 2020s to see where the capital went. And finally, we will show you the math of your purchasing power in the modern world. This is the story of why being close to the source matters more than your salary. To understand the situation, we have to go back 300 years. Before the central bank and before the algorithm, we have to go to the Paris of the 1720s. The French economy was in debt, the leadership needed funds. The solution was a new financial innovation, paper money. In the middle of this experiment stood a man named Richard Cantillon. Richard Cantillon is an economist many have not heard of. While others are famous, Cantillon understood the mechanics. He was a banker and a strategist. He understood markets better than anyone else. In the early 18th century, a financier named John Law convinced the government to switch to a system of paper money backed by potential future value. It was an early version of monetary expansion. They printed money to buy shares in a company, driving the price up. The people of Paris rushed to buy shares, believing the value would rise forever. But Cantillon saw the mechanics. He realized that when new money is created, it doesn't appear everywhere at once. It has an entry point. He watched as the new paper money flowed first to the insiders, the early investors and the associates of the bank. These people received the money before prices rose. They used this new capital to buy land and assets at the old low prices. By the time this new money reached the merchant or the worker, the market had changed. The spending by the wealthy had driven up the price of goods and rent. The average person received the new money last, but they paid the higher prices first. Cantillon acted on this. While others bought, he sold his shares at the peak. He moved his wealth out of the paper currency and into hard assets before the system corrected. And the system did correct. The value collapsed. Many citizens lost their savings, holding paper that had lost value, while Cantillon kept his wealth because he understood the flow of capital. Cantillon's insights were precise. Years later, in 1734, his London home was destroyed by fire. He passed away during the event. However, he left behind a manuscript. It was called Essay on the Nature of Trade in General. It contained the Code of Economic Inequality. It contained the Cantillon Effect. In his essay, he used a simple analogy. The gold mine. Imagine a closed economy. Everything is stable. A loaf of bread costs 1 coin. Now imagine a massive new gold mine is found. The total money in the system doubles. Basic logic suggests prices should simply double. But Cantillon said, no. He argued that who gets the gold first matters more than the gold itself. The owners of the mine get the new money first. Their income increases, but prices haven't changed yet. They are still buying bread for 1 coin. So the mine owners live well. They buy more resources because they have fresh money that hasn't lost value yet. This spending creates a ripple. The merchants who sell to the mine owners see sales go up. They feel wealthier. They spend more too. But as this demand moves outward, it hits a limit. When the mine owners buy more, they bid up the prices. Now look at the people furthest from the mine, the farmer in the distance. They haven't received any new money yet. Their income is the same. But when they go to the market, the price of bread has doubled. They are experiencing a loss of purchasing power. The value of their wages has been transferred to the people at the mine. By the time the new gold reaches the farmer, it is too late. He has spent years paying higher prices. He has fallen behind. This is the Cantillon Effect. Money flows like a wave. If you are at the start of the wave, you gain. If you are at the end, you lose value. You might think, we don't use gold mines anymore? You are right. We have something more efficient. We have the creation point. In the modern world, new money is created digitally at the central bank. But the physics are the same. The question Richard Cantillon asked is the only question that matters. Where does the money enter? Does the central bank send funds to teachers or workers? Does new money appear in your savings account to help with costs? No. In our system, new money enters through the financial sector. The central bank purchases bonds from large banks. This is called quantitative easing. The banks and financial institutions are the mine owners of today. They get the new liquidity first. They get it at very low interest rates. And what do they do with it? They buy assets. They buy stocks. They buy bonds. They buy real estate. This is why when the money supply expands, the stock market goes up. The inflation happens there first. Asset prices rise immediately, benefiting those who own assets. They feel wealthier. They spend more. But you, the wage earner, you're the farmer in the distance. You don't own the assets that are rising. You just buy the goods that are getting expensive. By the time the money reaches your paycheck, your rent has gone up. Your groceries are up. You are moving on a path that is being changed by the managers of the economy. This is the system functioning as designed. And never has this been more visible than between 2020 and 2025. We saw a massive expansion of the money supply. We saw a large transfer of value from the working class to the asset class. We have exposed the mechanism. We showed how money benefits those at the source. But then came the year 2020. What happened between 2020 and 2025 was a compression. We compressed decades of monetary expansion into 5 years. We will trace the capital. We will look at the data of the largest liquidity event in history. We will answer one simple question. Where did the funds go? While the world paused, the financial system opened the flow. To understand why bills are high in late 2025, look at the money supply chart. For most of history, the line moves slowly. In 2020, it went vertical. The central bank and the Treasury worked to put liquidity into the system. Trillions of dollars were created in months. Now, remember the rule. Where does it enter? The public was told this money was for them. It was the stimulus. And yes, some went there. But that was the smallest part. The majority entered through the financial window. The central bank lowered interest rates. But they went further. They began buying assets. They bought mortgage securities. They bought treasuries. They even bought corporate bond funds. This is the entry point. By buying these assets, they supported the price. They told the market, we will support you. Who owns these assets? Who holds corporate bonds? Who holds millions of shares? Not the average worker. It is the large funds and the primary banks. They received the signal first. They had access to capital at low rates. And they did exactly what Cantillon predicted. They acquired assets. This created an economic anomaly. In 2020 and 2021, the real economy was struggling. Production slowed. By logic, the markets should have declined. Instead, they rose. Why? Because the monetary expansion went into the assets first. The capital had to go somewhere. So it went into bidding up the price of existing assets. The stock market hit highs while supply chains paused. Real estate prices rose significantly. Economists called this a K-shaped recovery. The top group, asset holders, went up. The bottom group, wage earners, went down. This was the Cantillon Effect. The mine owners used the new money to buy the country's assets before prices adjusted. This is where the shift became permanent. Institutional investors began buying homes. They were bidding against families. But the family was bidding with wages that hadn't changed. The institution was bidding with new capital borrowed at low rates. The institution wins. They bought the real estate. They converted the fresh money into hard assets before inflation hit consumer goods. While this was happening, store prices were stable. Why? Because of the delay. It takes time for money to travel from the investor to the consumer. In 2021, the money was in the financial markets. The wealthy were trading assets. The central planners said price increases were temporary. They were incorrect. Then the barrier broke. The money moved from Wall Street to Main Street. The investors spent their gains. The money moved from assets to consumption. And the temporary inflation became the cost of living reality. By 2022 and 2023, purchasing power declined. Essentials, fuel, rent. Prices reset to a new level. Here's the difficult part, the sticky wage. Prices change instantly. Algorithms change prices in seconds, but wages change slowly. So when costs went up, your paycheck stayed the same. For 2 years, your real income dropped every month. The raise you asked for in 2024, it was absorbed by the previous inflation. The asset owners had already locked in their gains. You were left holding currency that bought less. Now, look at late 2025. The media says inflation has slowed, but slowing down does not mean going back down. Prices are not returning to 2019 levels. That value is gone. The loss in purchasing power is permanent. It has been transferred. It sits in the equity of landlords. It sits in the portfolios of banks. It sits in the profits of companies that raised prices. The liquidity event of 2020 reordered the economy. It made it harder for the middle class to accumulate capital. You can pay your bills, but it is harder to save, harder to acquire assets. But the story doesn't end here. The system is mathematically unbalanced. The structure is straining. We have talked about history. We have talked about the central bank. But we need to look at the math of your life. In this final chapter, we face the reality of your economy. We will calculate the hidden cost. We will explain why working more is not enough. And we will ask, Is it possible to succeed in this system? There's a cost you never voted for. It is paid every time you spend money. When the price of goods rises, that extra cost is a transfer. You are working the same hours but receiving less value. The difference has been absorbed by the creation of new money. Think of your savings as a battery. You convert energy into money to store it. You are storing time. When the system creates new money, they are draining energy from your battery. This is the hidden cost. If the money supply expands by 20% and your savings yield 0.5%, you have lost value. Richard Cantillon understood this. He knew that money is a claim on resources. If you create more claims, existing claims are worth less. The wealthy hold assets. The average person holds currency. And because they hold currency, they pay the cost. So, what is the advice? Work more, be productive. For 50 years, workers have done that. Since 1971, productivity has skyrocketed. We have technology. We produce more than ever. We should be living richer lives. But we aren't. The productivity gap is the result of the Cantillon Effect. The extra value you created was absorbed by currency devaluation. You're moving faster, but the path is moving faster. When housing rises significantly and wages rise slightly, catching up is mathematically difficult. You cannot outwork the printer. If you save money, but assets rise faster than you can save, you are falling behind. The old rules, save cash, work hard, were for a time when money held value. In a world of expanding money, those rules result in loss. We are moving toward a society defined by assets. On one side are the asset holders. They own land, businesses, gold, and digital commodities. When the money supply expands, their net worth rises. They are protected. On the other side are the wage earners. They sell time for money. When the money supply expands, their costs rise. They are exposed. It is easier to stay wealthy than to get wealthy. The gap widens because of positioning. So, is there a solution? You cannot stop the central bank. You cannot stop the expansion. But you can move out of the danger zone. The only way to win is to realize that currency is not the measure of success. It is the tool of transfer. Step 1. Change your measurement. Stop measuring wealth in depreciating currency. Measure wealth in ounces. Measure it in land. Measure it in finite units. Step 2. Become the mine owner. You cannot print money, but you can own the assets that new money flows into. Every time you convert your paycheck into a hard asset, you're moving closer to the entry point. You're getting ahead of the expansion. Stop saving in vehicles that lose value. Start saving in vehicles that hold value. Step 3. Opt out. Hold assets that do not rely on a bank or government promise. When you hold physical gold or self-custody digital assets or productive land, you are building a foundation that cannot be diluted. This is survival logic. The great transfer is happening. Wealth is moving from the liquid to the solid, from the paper to the real. You have a choice. You can stay on the path, paying the hidden cost, or you can step off. You can choose to store your life in something that cannot be diluted. Richard Cantillon saw the issue coming 300 years ago. He moved his wealth in time. The signs are here again. Where are you going to stand?